There is a number that governs the monetary conditions of more than 1 billion people. Central bank governors are summoned before parliaments to explain it. Financial markets watch it more obsessively than any earnings report or geopolitical event. For 3 decades, it has shaped interest rates, exchange rates, credit conditions, and asset prices across the entire developed world. That number is 2%. It is treated, in modern monetary discourse, with something approaching the reverence of a natural constant. It sits in the mandates of the Federal Reserve, the European Central Bank, the Bank of England, the Bank of Japan, and dozens of others. And yet, almost nobody, including the economists who defend it most vigorously, can explain why 2% is correct, rather than 0 or 1 or 3. Its authority rests not on economic theory, but on institutional inertia, the accumulated weight of 3 decades of repetition by the most powerful financial institutions on Earth. The story of how 2% became the global target is not a story of scientific discovery. It is a story of institutional accident, political convenience, and the quiet burial of an older, more honest definition of the word at the center of it all. That word is inflation. The global target did not come from a model. It came, in the late 1980s, from the most unlikely of places, New Zealand. Emerging from a decade of inflation that had run persistently above 10%, the government wanted an institutional framework that would signal its commitment to discipline and restore credibility with investors. The Reserve Bank of New Zealand Act of 1989 made price stability the singular mandate and required the governor to sign a numerical target with the finance minister. The first agreement, signed by Don Brash in 1990, specified a range of 0 to 2%. The choice of 2% was, by the participants' own testimony, pragmatic. There was no model that produced it as an optimum. It was low enough to be credible and wide enough to give the central bank flexibility. Brash himself later admitted the number had no deep scientific foundation. It was a reasonable guess at what near enough to 0 looked like in practice. From that accidental origin, it propagated with remarkable speed. Canada adopted a target in 1991. The United Kingdom followed in 1992, after the collapse of sterling's membership in the European exchange rate mechanism forced the Bank of England to find a new anchor. The European Central Bank defined price stability as below but close to 2%, and the Federal Reserve, paradoxically the last, only formalized its 2% target in January 2012. By then, it had already been the de facto global standard for 20 years. The Fed's move was confirmation of an orthodoxy, not the founding of one. The speed of that propagation was never matched by the theory behind it. The arguments were built after the fact. There are 3 of them, and each falls short. The first is measurement bias. Standard price indices overstate the true cost of living, so a measured 2% might reflect a true rate closer to 0. But notice what that implies, that central banks are explicitly targeting a measurement error. The second is the 0 lower bound. A positive inflation buffer gives the bank more room to cut rates in a downturn. But that is circular. It is an argument for inflation as insurance against the consequences of past inflation, and it justifies no specific number. The third is wage rigidity. A little inflation lets real wages fall without nominal cuts, lubricating the labor market. Fair enough. But if 2% is the right lubricant, why not 3 or 4? None of these produces 2% as a rigorous optimum. The choice remains as arbitrary as it was when Brash signed that page in Wellington. But the arbitrariness is the secondary problem. The primary one is deeper, a redefinition that took place gradually, without announcement, over the 20th century. The word inflation did not originally mean rising prices. In the classical tradition, from Hume and Ricardo through John Stuart Mill, inflation meant an expansion of the money supply. The word comes from the Latin for to blow into, to inflate. An inflated money supply was one expanded beyond the requirements of legitimate activity. And that definition had a precise virtue. It described a cause. Monetary expansion was the action. Rising prices were only one of its consequences. The Austrian economists insisted on this. Ludwig von Mises, in The Theory of Money and Credit, distinguished rigorously between the inflationary act, monetary expansion, and its effects, of which consumer prices were only one, and rarely the most important. For Mises, the evil of inflation was not that it raised the price of bread. It was that it distorted the entire structure of relative prices, sending false signals that led entrepreneurs to misallocate capital. Murray Rothbard was blunter still. Redefining inflation from money to prices, he wrote, was one of the most consequential acts of intellectual obfuscation in the history of economic policy. If inflation means rising prices, then the central bank, which creates the money, escapes the indictment entirely. And the target is only as meaningful as the instrument that measures it. The history of the Consumer Price Index since the 1990s is, in important respects, a history of methodological choices that lowered the measured rate. The Boskin Commission concluded in 1996 that the CPI overstated inflation by more than a full percentage point. The reforms that followed, hedonic quality adjustments, geometric weighting, new substitution rules, all moved the index systematically downward. The most telling case is housing. In the U.S. index, the cost of owning a home is not measured by house prices, which tripled in real terms between 1990 and 2006, and have soared again since. It is measured by owner's equivalent rent, a survey of what homeowners guess they could charge to rent their own homes. That single choice insulates the measured rate from the largest asset inflation of the modern era, and lets a central bank declare victory over inflation while the population's primary expense escalates. Which brings us to what the target actually permits. A 2% target does not restrict money creation. It permits whatever monetary expansion is required to push the index up to 2%. And whatever expansion flows into asset markets instead, into equities, into real estate, into bonds, leaves the index untouched, and so counts as success. Charles Goodhart's law applies with full force. Any measure that becomes a policy target ceases to be a good measure. In practice, the 2% target functions less as a ceiling than as a floor, an instruction to keep the printing press running until measured prices rise to meet it. So look at what the money supply actually did. Between 1990 and 2024, the Federal Reserve's balance sheet expanded from around $300 billion to over $7 trillion, more than a 20-fold increase. The European central banks grew from zero at its founding to over $8 trillion at its peak. The Bank of Japan's exceeded the size of Japan's entire economy, and broad money, M2 in the United States, rose from roughly $3 trillion in 1990 to over $21 trillion by 2022. In the original, monetary definition of the word, this is an era of extraordinary inflation, the greatest sustained expansion of money and credit in peacetime history. That it did not show up in consumer prices, at least until 2021, reflects where the new money flowed, absorbed by Chinese goods deflation and by asset prices. The greatest equity bull market on record, a global real estate boom, and a bond rally that crushed yields to levels without precedent. The monetary inflation was there. The index simply did not record it. The bill came due in 2021. COVID disrupted precisely the global supply chains that had been absorbing 3 decades of monetary expansion. Remove the deflationary offset, add a demand surge funded by central bank money, and the index finally registered what the money supply had been doing all along. The inflation the 2% target had declared absent arrived with unusual force. The Austrians, in the end, were right about the definition, not as pedantry, but as prediction. Redefine inflation from money to prices, Mises argued, and you obscure the link between money creation and distortion. You give central banks a metric they can claim to manage while doing the very thing the old definition was meant to constrain. The post-2008 era is a precise description of what he foresaw. The 2% target is one of the most successful pieces of institutional marketing in economic history. It took an arbitrary number from a pragmatic compromise in New Zealand and, through 3 decades of repetition, gave it the appearance of a scientific standard and the authority of a legal mandate. Restoring honesty does not require a revolution. It requires only what the best economics has always demanded: to define terms clearly, to ask what a measure actually measures, and to resist the comfortable illusion that a number, repeated often enough by authoritative enough institutions, becomes a truth. This is Game of Francs. The full article, with the charts, the data, and the methodology, is at gameoffrancs.com. Subscribe for the next one.